Options trading for beginners. So in this video, I'm going to talk about the iron butterfly. So please watch the series on my options trading for beginners, which I'll link below. I've got a playlist on options trading for beginners. So this video, I'm going to talk about iron butterflies. So basically, what is an iron butterfly? So it's a combination of a vertical call spread and a vertical put spread, but they have one strike in common. They share one strike. So I'll show you an example. So first of all, let's look up SPY, for example. So option, make sure I'm under option, look up SPY. And then under this list, under calls and puts, I'm going to choose iron butterfly. And then I'm going to choose the expiry that I want. So for this example, I'm just going to choose November 20th because it is a monthly expiry, so it has more liquidity. So as you can see, there's always one strike that's the same. Now, if you don't find the strike that you want, you can just click anywhere, click buy and sell. It's going to give you an order entry window, SPY iron butterfly, and you could choose the strike that you want. You could change it afterwards, so it doesn't matter. And like with the vertical call spreads and with the iron condors, you can buy an iron butterfly or you could sell an iron butterfly to begin with. If you buy an iron butterfly to open the trade, then you have to sell it to close the trade. If you sell an iron butterfly to open the trade, you have to buy it back to close the trade, or you can let it expire worthless. So I'll give you an example. And obviously the assumption is different if you buy the iron butterfly or if you sell the iron butterfly to begin with. So the iron butterfly is not necessarily a high probability trade, but the premiums are high. So in my opinion, it doesn't make sense to buy an iron butterfly because you're going to be paying a lot. It makes more sense to sell an iron butterfly because you'll be collecting more premiums. But let's look at the example of buying an iron butterfly. So SPY is at 329 right now. So let's say I want to buy the at the money iron butterfly. So 329. So I'm going to buy the 329, or just to make it simple, I'm going to just buy the 330. And then I'm going to sell the 335 call. So I'm buying the 330 call and I'm selling the 335 call. And then on the put side, I'm going to buy the same strike to make it an iron butterfly. I'm going to buy the 330 put and I'm selling 5 points lower. I'm keeping the same width between the strikes. So I bought the 330, so minus 5 is 325. So I'm going to sell the 325 put. So what does that look like? What does that do? What's the assumption here? As you can see, I'm going to be paying a lot. I'm going to be paying $4.70 for this trade. So if I do one contract, that's $470. But what's my max profit? The width of the strike. So the same thing as the vertical calls and the iron condors, the width of the strike is my max selling price. So 335 minus 330 is 5. On the put side, I've got the same width. So 330 minus 325 is 5. So my max selling price, regardless if SPY is above 335 or if it's below 325, my max selling price will be $5. If my max selling price is $5 and I paid $4.70 to get in, then my max profit is only 30 cents. If I did one contract, that's $30. So the assumption though is if I do this trade, if I buy this iron butterfly, that's because I truly think that SPY will be will either be above 335 come November 20th or will be below 325 come November 20th. So I know it's going to move hard. I don't know which direction. So that's why I'm buying this iron butterfly, because I know it's going to move hard in either direction, and I make profit if the SPY is indeed above 335 or below 325. But as you can see, I'm paying a lot up front. My max loss, my max risk is what I paid, so $4.70. But my max risk occurs if SPY ends up expiring at exactly 330 on November 20th, which is very hard. It's really unlikely that it expires exactly at 330. But if it expires, for example, at 332, let's say it expires at 332, then I'm going to be able to sell this iron butterfly for $2. So I paid $4.70. I can sell it for $2. So I will have lost money, but I will have lost only $2.70. So if it's at 332 and we'll look at the value of each option. So the 330 call will be in the money by exactly $2. So it's going to be worth $2 at expiry. The 335 call is going to be worthless because it's out of the money. The 330 put is going to be worthless as well because it's out of the money. And the 325 put is going to be worthless because it's out of the money. So I'm basically selling a call option that I bought for $2. So my net credit from all these options from this whole trade will be $2 come expiry. I paid $4.70. I'll be able to close this whole trade for $2. So I still lost money, but I lost only $2.70 instead of losing the full $4.70. So that's if SPY is at 332 come expiry. If SPY is at 326 come expiry, for example, this call option is out of the money. This call option is out of the money, so it's zero, worth zero. This put option is going to be in the money by $4. 330 minus 326, $4. This put option is going to be out of the money, so it's going to be worth zero. Sorry, I don't know if I said out of the money, but this put option is going to be in the money. The 330 strike is going to be in the money. So in the money by $4, 330 minus 326. So my net credit in this case will be $4 from this whole trade. Everything's going to be worth zero except this one here, the 330 strike that I initially bought. I'll be able to sell for $4. So I've got a net credit of $4 from this whole trade. But for this whole trade, I paid initially $4.70. So I lost only 70 cents in this case. So as you can see, the further the SPY is trading from my 330 strike, the better it is for me. That's in the case of buying an iron butterfly, but that's the assumption that I have if I'm buying an iron butterfly. But as you can see, it doesn't make sense because my profit is very little. I'm paying so much up front just to make 30 cents potentially. So the other thing I could do with an iron butterfly is sell it. And usually you would want to sell it if the implied volatility on the stock is high because the premiums will be higher. So if I sell this exact same iron butterfly, I just simply click on sell instead of buy. And you could verify that I'm selling the 330 call and I'm buying the 335 call. So this is a vertical call spread. And then I'm selling the 330 put. So it's the same put, the same strike, sorry, is being sold on the call side, on the put side. So that makes it an iron butterfly. So I'm selling the 330 put and I'm buying the 325 put. So that's a vertical put spread. So this is a call credit spread. This is a put credit spread. And in this case, instead of paying $470, I'm actually collecting $470. So that's money that's coming into my account. So if I'm doing one contract, that means 400 times 100. So $470 comes into my account. But do I keep that $470? Well, it depends. For me to keep that premium, SPY needs to close on November 20th at exactly 330. So it's very unlikely. But the closer I am to 330, the more money I make. My max loss on this trade is very small. My max loss is only 30 cents because it's a difference between the strike, so $5. Basically, my max purchase price or my max closing price, the max that I'll have to pay to close this trade is the difference between the strikes, so $5 minus what I collected, so $470. So the max I'll lose is 30 cents, and it will happen. My max loss will occur if SPY is trading below 325 come November 20th, or if it's trading above 335 come November 20th. But if anywhere near 330, it'll be much better for me. For example, if it's trading at 332, then this whole trade will cost me $2 to close on November 20th. So that means my profit is the difference, $2.70. If it's trading at, let's say, 334, then this whole trade is going to cost me $4 to close. I collected $4.70 to open the trade. So my max profit in this case will be 70 cents. So you can see the range is much smaller. The range of winning is much smaller. But if it does happen, my gain is much bigger. So that's how an iron butterfly works. And always just be careful if you've got an option that's in the money or or very close to being in the money, and you're on the last day of expiry and it's 2 p.m. The broker might close the trades for you if they feel like your account cannot support assignment or exercise. So just be careful with that. Try to close your trades yourself before 2 p.m. on expiry. So for example, if it's November 20th, so on Friday, November 20th, before 2 p.m., try to close your trades if you feel like your account would not support one of these options getting exercised or assigned to you. Even though max loss is predefined, but getting assigned could still happen, and that would generate more losses into your account. So try to close your trades before expiry. All right, so if you have any questions, leave them in the comment section below. Like always, if you can open an account with Questrade to trade on the stock market, use my referral link below to get $50 in free trades. Also check out the other referral links below. If you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.